Hi everyone. So in our last class we expanded the owner's equity account. We now know that owner's equity is comprised of three different accounts: revenue, expenses, and drawings. These three new accounts do not ever get added to the balance sheet, but they get their own financial statement. It's called the income statement. In this video, I'm going to show you what an income statement is and how to create an income statement. An income statement tells the owner and managers of a business how a business is doing. It lists all of the revenue and all of the expenses. It clearly shows you how much money a company has made and how much they're spending on various items to run the business. Income statement is defined as a financial statement that summarizes revenue and expenses, and it shows the net income or the net loss. So how much money a business has made in total or how much it has lost in total for a given period of time. This is what an income statement looks like. It looks a lot different than a balance sheet. However, it's easier to create than a balance sheet. The first thing that you do when you're creating an income statement is add the title, just as you would with a balance sheet. The title will be done the same way as it is for a balance sheet. You would start with the company's name and then tell me which financial statement it is. In this case, it's an income statement, and then you'll write the date. You'll notice the date is a little bit different than it is compared to in a balance sheet. The date here says for the year ended and the date is written. You will also have to write for the year ended before you write the date. The next step in creating an income statement is recording the revenue. The title, Revenue, will be written and the forms of revenue will be listed underneath. In this case, the company makes money by selling chartered flights and also by selling flying lessons. The monetary value beside each form of revenue will be listed in the first column. These values are coming from the T-charts or the ledger accounts. They're the circled final amounts. Then you're going to do a total revenue. You're going to add up the different ways the revenue is being made and then have a total value. That total value you will write or you'll place in the second column. Once you have completed the revenue section, the expenses will be recorded. You will title the expenses section Expenses, and then you're going to list all of the expense accounts in alphabetical order, from A all the way down to Z. Once you've done that, you're going to list up their monetary values. So advertising is $503, bank interest and charges are $2,756, and so on and so forth. Once again, these numbers are coming from the ledger accounts or the T-charts with the final circled value. Once you've listed all of the expense accounts, along with their monetary value, you will total up the expenses at the bottom, right here. A single underline will be added after the very last expense has been added to the list, and then your total for all the expenses will be written into the second column, just like it was for the revenue. The last thing that must be done in completing the income statement is calculating the net loss or the net income. In this section, you're going to your total expenses are going to be subtracted from your total revenue to give us the net income or the net loss. The net income is the difference between the revenue and the expenses. It shows us how much money a business has actually made after the expenses have been accounted for. If this were a negative number right here, that means that you have made a net loss. It means that your company is actually losing money because your expenses are higher than the revenue. And there you have your income statement. So why is the income statement important? Well, the income statement is important to a variety of different individuals. Owners and managers will always use the income statement because it shows if the business is making a profit. It's used for setting goals and policy. So when managers or owners were to look at an income statement, they could decide if they're meeting their financial goals or if their expenses are too high, maybe they want to curb their expenses. Also, it's good to have when you're comparing various income statements over previous years and you're trying to come up with a trend. Also, bankers or investors use income statements. It helps support loan decisions. Also, Looking at past profitability is an indicator of future potential. It'll help investors decide if they should be investing in certain companies or not. The income statement is also important for the government. It's important for income tax purposes. Every business is required to prepare an income statement by law. The net figure of a business must be included to the owner's income tax return. Corporations must file their own tax returns, and the income statement must be sent to the government along with the tax returns. And there you have your income statement. In class, we're going to be practicing making our own income statements.